Weibo, another Chinese company. Let's see this one. What we got? So, net income margin. Let's look at the profitability. Before I start, Weibo is basically Chinese Twitter. Chinese Twitter. It's basically Chinese Twitter. All right, financial performance. Yeah, same thing with Baidu almost. Actually, exactly the same thing with Baidu. It kind of shows you there's a pattern growing here with Chinese companies. Declining margins. Again, can be explained by number one, the fact that other, on top of other social media sites, in Weibo's case, even Baidu and other um, social media ad-based platform sites are starting to eat into Weibo's margins. Now, you have to understand these companies have grown to such an extent that they're now not only competing with each other, but they're competing with, for example, regular television. Regular television and streaming sites are coming on play. So they're and gaming as well. So they're competing with a lot of other smaller players for the same customer, for the same ad dollar. And that would go a long way to explain the declining margin. So Weibo declining margins, not good. Increase in competition, increase in competition, as well as product risk. The fact that it gets most of its revenue from, its microblogging, its so-called Twitter side of the business, ad-based revenue, basically. That's where it gets most of its revenue. So, like Baidu, market risk, too many competitors competing for too few advertising dollars, starting to eat into each other's lunches, into each other's margins, as well as product risk. Not that diversified. Weibo is trying to diversify into other segments, but quite a lot of its revenue still comes from ads. So that's gonna make competition. That's gonna make that's gonna lead in the short term to a lot of pain. So deterioration, you can see deterioration in the margins. Looking at the cost side, you can see the fact that cost of revenue has been decreasing. So you can say good cost control, the fact that they're reacting to the fact that margins are declining. So spending high levels or a sustained high rate on a certain cost of revenue is unjustified. So decreasing it. R&D growth has for the past years 2019 2020 been stable. All right. Trying to keep it stable, not trying to basically, you're trying to get good cost control, but you're not trying to lose pace with the bigger boys. R&D as a percentage of revenue, roughly, it's been increasing at an upward trend. All right, that tells me you're still spending significantly on R&D. That one can be happy with. Now, is it justified what you're doing? That could be another question, but you still need to spend on R&D, not to lose track, not to lose pace with the bigger boys. So, is it justified? No. Looking at the fact that you're spending so much on R&D, you decrease cost of revenue, you're still spending quite a bit on R&D, you're still spending a significant amount on sales and marketing. Now, sales and marketing as a percentage of sales is at 31, 26, 27%, average of 28. The industry average for these companies with regards to sales and marketing as a percentage of revenue is about 25%. Weibo's paying 28%, but revenues have been declining. And net income has been declining. So this high level of spending on sales and marketing is clearly not justified. You're spending quite a lot of money on sales and marketing for declining revenue, declining net income, and depreciating margins. So that is very worrisome. That's a no-no. Spending on R&D as a percent of revenue is still quite high, even though your revenue are declining. That's a bit worrying because you're not efficient. Now, general admin cost, the growth of it, you can see there's a massive spike in 2019, but a significant downscale of it in 2020. So, costs have gotten a bit out of hand in 2019, but Weibo has reined them in 2020, which is very good. So that's a good positive. You're realizing you're spending way too much and costs are not justified. But there are other costs where Weibo is still spending a lot, and it's not resulting in growth in the top and bottom line revenue and net income, and the margins are not being protected at all. They're still declining. So that to me worries me a bit, that they're not efficient in their costs. Their costs do not just, the increase in cost does not justify the way the company is actually performing. Furthermore, in 2018, there was interest expense. It was about 15 million, but in 2017 there was nothing. So obviously you cannot get the growth of that because it's 15 million divided by nothing over nothing is, well, nothing. So, but just know there was interest in 2018, but the increase of that is quite difficult. Well, you can't calculate it. Well, yeah, you cannot calculate it because the denominator is basically zero. But there was an increase. Just know that. So you went from zero in 2017 to something in 2018, and then it started, and then of course it's been increasing at a very high rate ever since. And that will be justified by the debt to equity ratio when we get to it. So the high interest expense growth has also been eating into margins. So you're borrowing a lot, but is this borrowing justified? Not really. It's eating into your margins, not increasing growth, not increasing revenue, not increasing net income. Net income has been declining, sales have been declining. I mean, net income has been a mess. Sales are a mess. Costs are eating into your margins. Higher costs are not justified. These higher costs are not justified because your margins have been declining. Your revenue and net income has been depreciating at a very rapid pace. You increased your borrowing base, which is eating significantly into your margins. And you look at those costs, 94, 92, that is just horrific. So, from a financial point of view, it's really doing bad. Return on equity. Hope it will give us a very, 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 very. I hope it'll give us some, good news, and it doesn't. Return on equity has performed well bad, horrific. Weibo only managed to outperform the S&P one of the 3 years. I mean, on average, it's managed to outperform the S&P because the S&P only returned 13% and Weibo returned 26%. So on average, it's managed to do good. But year to year, in 2018, it was the only way to overperform the S&P. In 2019, it underperformed. 2020 also underperformed. But in average, in total, it did overperform. And it gives you a mixed result. All right. Now, if you read that with the rest of the profitability analysis, it's been underwhelming. So on average, yeah, but they've been very good utilizing shareholder capital. But on a year-to-year basis, reading everything together, the whole profitability analysis together, it's been underwhelming. It's been underwhelming. The margins are not healthy. The top and bottom line continues to significantly decline and depreciate. Certain costs are not justified because they're eating into margins, and they're not being justified because said margins are still declining, revenue is still declining, net income is still declining. So it's a bit of a mess. From a profitability point of view, I'm not happy. I am not happy. I mean, good, they've managed to stay profitable and they're still getting quite strong margins, but the trend that I'm seeing is quite horrifying in my view. Not doesn't give me a lot of confidence. Current ratio, current ratio, very good, very good. Now remember, Weibo operates in the social media ad-based platform industry, which, as we discussed earlier, is very asset-like but cash-heavy. So you do expect a good current ratio. It's been increasing, and that's been because of the fact of the cash generated through operations, plus the fact that it's been borrowing quite a lot of money. So it does have a significant bit of cash on hand. So this is very good. 5 to 1, meaning your assets exceed your current assets, your short-term liability. Sorry, your short-term assets exceed your short-term liabilities by 5 times. Very good. Very good. So liquid. So the balance sheet is liquid. This indicates me the balance sheet is very liquid. It has enough cash to weather any storm as well as to pay your liabilities. Debt to equity, however, paints a very worrying picture. Debt to equity shows me the company has added a lot of financial risk, a lot of credit risk. It's taking on a lot of debt, and it's been increasing. In 2020, that means for every dollar of net worth I have, I hold $1.23 of liabilities. So my liabilities exceed my net worth by a factor of 123%. That is not good. That is not good. But again, it does explain the massive increase in the borrowing base. We're taking on more debt, and we're paying on more expense, and we're paying more interest expense, but revenues are still declining, the income is still declining, the margins are still depreciating, still earning lackluster returns. So yeah, increasing financial risk for none of the reward on the financial performance. The margin is still declining, the top and bottom line is still declining as well. So taking on a lot more financial, taking on a lot of more financials, a lot more credit risk, and it's not really being realized in terms of profitability. Not happy with that. Not, not, not happy with it. Not, not, not happy with it. All right. Again, looking at the debt to return relationship. Increasing debt, increasing risk, decreasing return. It's not good. That is very not good. That's a lot of very that I said right there. But yeah, I mean, the debt degree does not instill a lot of confidence. So overall, on the balance sheet, I'm not against the increase in debt. It's just that it needs to be justified. And as things stand, it isn't. But anyway, let's read further into the analysis, and maybe we can justify that increase in debt, or the company's financial information justify that debt. Now at liquidity from operations. So how liquid are the company's operations? Liquid is Weibo's operation. Cash from operations margin. It's been increasing. It's been increasing, which is amazing considering the margins have been declining, but it's been increasing its ability to generate cash from revenue. Okay, that's good. All right, that's good. Your margins are decreasing. That means the operations are strong enough that you can generate maximum value of cash flow from each dollar revenue you generate. So for each dollar revenue generates, it makes about 44 cents or 44% in the form of pure cash. Good. Very good. So how are you using these good margins? So how are you using these good margins to basically stabilize your platform, your operations, and continue to strengthen them. Looking at my sufficiency of cash flow, like that tells me it's a bit of a worrying trend. Now, what this tells me is, okay, you do have sufficient cash flow, but it's been depreciating very rapidly. 20. Again, that is understandable considering you are taking on a bit more debt, and you have taken on this debt with the intention, with the view to grow and expand your operations. So, okay, so slight decline, but still good. You still have sufficient cash flow to pay the debt holders, return some money to shareholders, as well as fund operations of more investing in the company. So we're investing in itself. But what do I see? See a depreciation, see a high cash margin, compounded with a decrease in my debt to equity, the added financial risk, substandard market returns, depreciating margins, revenue, and net income growth. So the company generating a lot of cash. Unlike Baidu, which had decreasing margins, Weibo has increasing margins. But it's not effective with these increasing margins because you're borrowing a lot, you have sufficient cash on hand, you have enough, well, the platform has enough in itself. The operations are so good that they're liquid enough to generate a significant um, part of cash from it. You have sufficient cash, but yet margins still decline. So I mean, it's a very interesting invest. So it was a very interesting investment case. Good margins, sufficient cash flow, but declining net income margins, declining revenue, declining net income growth. So this, as an investor, is a bit worried because what it tells me is that Weibo is not very attractive. It's not very attractive from my investment point of view, because you're wrecking the balance sheet when you have sufficient cash on hand. Why do you need to borrow more money when your margins are in decline, but you make enough money from your operations and you have sufficient cash on hand? Why are you adding more in terms of debt? Because if you're adding more in debt, but the margins were improving and net income was improving, revenue was improving, your returns were above market, that would be okay. But you don't have a hole in funding. Weibo doesn't have any hole in funding. Its operations are liquid enough. Does it really need to borrow at such rapid rate to a point where debt is 123% of net worth? So these are very scary numbers to me. Reading them together is very scary, showing me that Weibo is not very efficient in utilizing its cash. The strategic allocation of its cash to add shareholder worth to improve profitability has not been very efficient. So it's not spending money in the right, and where it is spending money, it's not generating enough benefit to justify said expenditure. So I'm a bit worried. I'm a bit worried as a shareholder. I'm taking on a lot of risk for no real efficiency actually with Baidu, with how it's used its great ability to generate cash flow. It's a good position that it's in from a sufficiency of cash flow point of view in generating growth in its operations. So not really a good sign. not at all. So the main argument from my point of view is that um, my goodness gracious, been underwhelming. You know, it really has been underwhelming. Anyway, let me gather my thoughts. There has to be something nice to be said about this company. So strategic allocation, we've talked about it, of cash, not that good. It's not in its good position to actually grow revenue while reducing financial risk, and it's taking on a lot of financial risk for no good reason. Overall, again, from the cash liquidity, it will get a tick from my view. Good, but it's not being utilized efficiently. It's not paying any buybacks, which I guess one can say you understand considering the margins are declining, no real growth, increased competition, which is eating into market share, but yet you're increasing debt, which is not really hitting your operation. I mean, increasing debt to expand, but you're not really expanding, instead contrasting. You're not expanding, actually regressing. But so a question could be asked. I mean, might it have been a bit better instead of increasing debt to probably start paying back shareholders? Again, very, very poor strategic allocation and use of cash here. PE of 29, quite expensive, but I don't even need to look at the PE. I mean, the financial analysis itself really does not paint a good picture on Weibo. Really done bad. Really, 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 really done bad over the past few years. I mean, it's really not been a good performer. I mean, you can see before uh, really been flat, really been flat, and in April, luckily for it, it managed to basically survive a massive drop point due to that increase in regulation. It's really been a flat performance stock, down 18%, really flat, doesn't pay any um, dividends or buybacks. Well, I would expect it to do a buyback, but I mean, really been a underwhelming performance. Stock price just indicates really been underwhelming, very flat. Nah, it's not the stuff for me though.